Welcome to today's FinLit session on optimizing investment returns for 2023. So what we intend to cover in today's session is looking at how the new taxes which are coming into play from January 1st, 2023 is going to affect your investment returns, and also looking at ways and means in which we can optimize the investment returns in the current tax climate. So as you all know, we've seen a steep increase in terms of taxation, both on employment income, personal income taxes, and also on investment related taxes. So what we would like to do today is we will take the session into two phases, where the initial phase we will talk about a couple of things, where we will talk about what the new taxes that are going to affect you in terms of your investments, and then do we feel that these taxes are going to come down in the near future, or is it going to stay? And if the current tax rates were to prevail, how do you kind of optimize your returns after taxes? And what are the most tax efficient products right there in the market right now, which can optimize your returns in the current investment climate? And also finally, we will look at what our views on interest rates are, and how you can kind of position yourself in the current economic and macro climate. So before we begin the session, let me give a little bit of brief into who we are and what we kind of do. So we are part of the CAL Group. So Capital Alliance, or the CAL Group, is a full-fledged investment bank which has operations in investment banking, asset management, stock brokering, and treasuries or primary dealing. So investment products, we offer a range of investment products ranging from government securities to various customized investment products, and also unit trust and customized portfolios. So to start off things, I'd like to invite Shehana Dain, AVP of our investment division, to give a brief in terms of what kind of new taxes are coming into play and how it is going to affect you.
Thank you, Udeeshan. Yes, so I'll first take you through what are the new taxes that have come to play and how it will affect your investments. So the taxes that really impact on your investment returns or investment income are mainly in four types. And number one is withholding tax, which came into effect from 1st of January this year. And number two is personal income tax, three, capital gains tax, and number four is the dividend tax. So next slide, we'll go into a little bit more detail as to how these taxes actually work. So withholding tax is applicable for interest income realized on fixed income instruments. So when I say the interest income realized, it's very important to note the word realized, which means that it's not about all income, but the income that you receive to your hand. Or rather, as an example, if you receive monthly interest income from any of your investments, that is a bank deposit, a financial company deposit, or even a unit trust investment that you receive on a monthly basis, then this tax will be applicable for you. So let's talk about the tax rate. It's 5%, which is deducted at source at the point of realization. Again, you have to receive this income to your hand, and let's say you have invested or made an investment, a fixed deposit in 2020, and it's maturing in 2023. You will be applicable or liable to pay the withholding tax rate at the prevailing current income WHD rates. The exemptions for withholding tax is treasury bills, bonds, and equities. So if you look at an example, let's take a very simple example of you're depositing 1 million rupees, and if we assume that the bank will pay you 25% for this particular deposit for 1 year, which means that you will end up earning around 150,000 rupees as interest on maturity prior to the tax. And the result, when the WHT is applied, that means the net of net of taxes, your take home will be 237,500. Next slide, please. So number 2 is personal income tax. This is applicable for any Sri Lankan individual who is residing in Sri Lanka and who earns income through various means, that is employment or interest or investment income. Again, equities are exempted, and tax rate or there's a slab related tax structure which is applicable based on which category the individual falls into. This includes salaries as well as investment income. So the first 100,000 is exempt, or in other words, 1.2 million annually per annum is exempt. And afterwards, every tax slab up until 308,000 is taxed at 6%, 12%, 18, 24, 30, and the highest at 36%. Next slide, please. So if we look at example, so we've taken 3 scenarios to show you how this will impact your monthly salaried income or any other investment income. The first example that we have taken here is to assume an individual who's earning a salary of 400,000 a month. So if you look at his entire salary, the first 100,000 will be completely exempt from taxes, and from 100,000 to 141,600, he'll be liable for a 6% tax component, which will amount to 2,500 rupees, and 141,600 to 183,200, it will be at 12%, that will amount to 5,000 rupees, and so on and so forth at 18%, 7,500, 24, 10,000, 30, 12,500, and finally, the remaining 192,000 will be taxed at 36%, which means 69,000, and all of this accumulated will amount to around 106,500. Which means that if it's an individual, his or her take home will be 393,500. Next slide, please. So the next scenario we have taken is an individual again who earns 500,000 a month. But in this scenario, he or she also earns a treasury bond coupon of 250,000 a month. One special thing to note here is that treasury bills and bonds are withholding tax exempt. There is no WHT component for government securities. So if you look at the total income of this particular individual, it will be around 750,000 because we have added the coupon payment of a treasury bond as well. Again, it will be treatment when it comes to tax and tax slabs 6, 12, 18, 24, and 30. Where it actually changes is in the final row, if you can see. Comparatively, previously, the individual was only having 192,000 that was taxed at 36%. But here, because the 250,000 coupon payment has been added, his final component increases to 442,000 at 36%, which means the tax component or rather the amount is 159,000. This amounts to a total income tax payable of 196,500, which is the increase from the previous example. But one has to also know this is also because of the coupon payment that he or she received on a monthly basis. Go to the third slide, please. So the scenario number 3. Like I told you earlier, except for government securities and equities, any other fixed income instrument is taxable when it comes to WHT. So let's assume an individual who has a 100,000 monthly salary and also earns a bank deposit interest of 200,000 a month, which is subject to WHT. How the tax treatment would work in instance like that? So again, 100,000 exempt, and we come to the final slab at 36%. This particular individual will be taxed. The final slab would be 442,000, that is taxed at 36%. And 159,000 would be the tax component for the final slab, and your personal income tax accumulated figure will be 190,500. But what will come in excess, or rather to be slightly different, not excess, slightly different, would be the WHT component. Here there will be a 5% WHT component on your return that you get from your bank deposit, because the bank will deduct that 5% and only give you the monthly interest. So it will be 12,500. But the impact would be identical, because with the withholding tax, it essentially becomes a tax credit where you can set off your total income tax liability and deduct the withholding tax component, and the impact or the take-home amount will be identical for an individual who would have either invested in a bank deposit and who takes a monthly interest, compared to an individual who has invested in a treasury bond who takes a coupon payment. The impact would be identical. Next slide, please. So the third type of tax that we will talk about when it comes to investments is capital gains tax. So it's applicable for capital gains on realization of investment assets, which includes property, T1, T-bills, and capital gains when it comes to trading of those assets. Which are excluded are equities, and if capital gains of trading is less than 50,000 a month or less than 600,000 a year. The tax rate is 10% for individuals and 30% for corporate. The cost consideration or how a property will be valued is for all the properties, the cost will be treated as the market value of the asset as at 30th September 2017. And if you look at an example for capital gains tax is if an individual buys a house for 20 million in 2019 and sells it for 30 million in 2023, very simply put, it's a 10 million gain. And out of that, 10% means the individual will have to pay rupees 1 million in capital gains taxes. Next slide, please. So if you look at the final component when it comes to investment-related taxes, it's the dividend tax. The treatment for this is very similar to WHT, and why I say that is it's applicable again on dividends on shares and equity. So if you take an example, let's say it's the dividend is declared for Dialog shares, and you hold a share 1,000 shares, and the dividend is declared for rupees 1 rupee and 50 cents per share. The total dividend will be around 1,500 rupees, and once 15% of that tax is withheld or dividend tax is withheld, the total dividend tax that has been reduced will be 225 rupees, and your take home would be 1,275. So it's who will be withholding and paying is the company. In this instance, we Dialog will be withholding that particular tax component and paying it for the shareholders. Next slide, please. So after I explain to you about the taxes that are applicable, then we'll look at what CAL's viewpoint in as to see if the taxes are here to stay, and also to look at what are the investment instruments available to ensure that you optimize your investment returns. And for that, I'll hand it over to Udeeshan.
Thank you, Shehana. Before I run through my slides, if you have any questions, feel free to drop in on the chat box, and we would be happy to respond to the questions during the Q&A session. To summarize in terms of what some of the things that Shehana touched upon, the critical things are that A, you will only have to pay taxes when the investment return is realized. So if an investment return is just accruing an instrument, you don't have to pay taxes on that particular year. So you only pay taxes on your returns if you have taken it as cash. Right? So that's the key concept and the most important concept that we have to keep in mind in terms of how we can use this realization concept to optimize our tax returns. Right? The other important things are that when it comes to personal taxes, obviously your maximum threshold is going to about 36%. But the 5% can be withheld, and you can offset it against the personal tax liability. And the other important thing is the only instrument which is kind of exempt from all the taxes are equities or investing in the share market, where capital gains are not taxed, and also your WHT is also exempt from the transactions. And to look at, okay, are these taxes here to stay? Right? So now if you look at the new tax brackets, the highest tax brackets have increased to about 36% from about 18% a year ago. Right? Does Sri Lanka have to maintain these kind of rates for the longest period of time? Right? So couple of observations. So if you look at the current income tax structure, the main reason why we have to push, or the government had to push the rates to about 36% on the higher end, is because there is a few number of people paying taxes at the moment, right? So to put numbers into perspective, in 2021, only 4% of the employed population paid their personal income taxes, right? So this is inclusive of employment income and so on. Only 4% of the taxpayers, only 4 payers of the employed population paid taxes during the year. This is in comparison to 17.5% of the population, which paid their taxes back in 2019, when it was automatically deducted from your salaries. In most of the cases, it was employment taxes, which was deducted at source. Right? But with the new taxes which came into play from 1st of January this year, we are going back to the old tax regime, where most of the taxes are going to be deducted at source. When I say most of the taxes, your employment taxes. So starting from this month, when you see your salaries, the government is going to deduct your taxes and send your salaries back, right? Also, in terms of your investment income, since most of the population invest in the typical bank deposit kind of products, even on your interest income, you will be deducted the 5% before you get the net interest to your hand, right? So automatically the bank will deduct the interest and the remaining proceeds will only come to your hand. This is different to the previous regime, where you have to declare your entire income, whether it being employment income or interest income, and you have to mention which bracket you fall into and pay that particular tax. Here the difference is now the main taxes like employment income tax and the WHD tax are going to be deducted by the withholding agents or at source. The bank will deduct for you in terms of the WHD on interest, and in terms of your employment income, your employer is going to deduct the salary, the taxes from your salary and send that the balance to your account, right? So the only way that there is a possibility that taxes can come down in the near future is if the government can improve its collections, right? So ideally, in ideal world, 100% of or almost 100% of the employed population should be paying taxes, but obviously there will be X percentage of the population which is falling below the 100,000 threshold. Right? But if you look at our peer countries, roughly on average, out of the employed population, 30 to 60% roughly pay taxes. So even in 2019, the 17.5% population which paid taxes was a very low amount compared to what it should have been. So what we feel is if the inland revenue really goes after people who are not paying taxes, if they can start going back behind employment income or even investment income by tracking the sources, which they are planning to do, they will be able to increase their collections at least by 70%. Right? So if they are able to increase their collections by 70%, they can afford to reduce the tax rates from the current 36% on the higher bracket down to about 24-25%. Right? So there is a possibility that they can bring down the tax rates in about 2 years or 3 years when the government has improved on its collections. Right? So as you all know, the inland revenue is working on new mechanisms in terms of tracking down people. For example, one of the key things that they've announced is that going forward, and it has not still been implemented, that every deposit or even any financial instrument that you have, the NIC number should be part of your bank deposit number or so on. So for example, in the future, if you have a particular bank deposit, it will start with your particular NIC number, 90, whatever. And the inland revenue should be able to find, if they put in the NIC number, they should be able to see all your investment related income, right? So that's the ultimate result that they want to get, right? But at the moment, they are still not there. Right? So at the moment, it's difficult for them to track, but eventually they're going to get there, right? So what you have to efficiently do is try to start paying and also look at efficiently managing the tax without looking at not paying the tax at all. Right? So if the government can improve its collections from 17.5% to 30%, where they can collect taxes from 30% of the people who pay, who are employed, they can raise the same amount of money at 24% maximum rates compared to the 36% rates which are there right now. Right? So there is still a possibility that in 2 years or 3 years time, these kind of tax rate can come down. Second is when your interest cost, because if you know, roughly about 70-75% of government's revenue right now goes into interest expense. Right? Even that they've been paying roughly about 30% interest on government securities, their interest cost has substantially increased. Right? So with interest rates coming down, if there is an IMF program which comes into play, treasury bills which are raised at 30% right now, or 28 to 30% right now, can fall below even 20%, right? Which effectively will reduce the government's interest cost, and which will mean that effectively government can afford to reduce the tax rate because their costs will kind of reduce. Right? So there is a possibility that these kind of 36% tax rates on the higher end is likely to reduce in 2-3 years time, right? And the range that we're looking at of 30 to 36% is the kind of tax rates that you pay in a developed country. Right? So you don't see very high rates in developing countries. So this is an abnormal rate that the government is using for the moment until they improve their collections. Right? So from our perspective, there is a likelihood chance that you can improve your collections in 2-3 years time, and by doing that you can reduce, they can afford to bring down the tax rate in the near future. Right? So in this context, where should you ideally park your money to optimize your after tax returns in terms of your investments? Right? So we look at a few options. Right? So one of the key products that we are talking about here is what you call the unit trust fund. Right? I'm sure most of you would have heard about the unit trust, but let me explain what a unit trust is before we look at how you can effectively manage it in terms of taxes. Okay? So what a unit trust basically means is that the unit trust fund manager, for example, CAL Investments is a unit trust manager. It collects a pool of funds from multiple investors. It can be thousands of investors who are even giving 100 rupees of investment. Right? So we pool investments from multiple investors, right? And then put that into a particular, we create a fund for that particular set of investors, right? And that set of funds will be invested in multiple products. So in this particular case, if you look at on the left-hand side, there's, say for example, you collected 1 billion rupees as total investments from individual investors, right? And that 1 billion investment, what the unit trust manager is doing is breaking it down into investing in company A, company B, company C, and also investing part of it in treasury bills. This is a hypothetical example that we put in. Right? So investment A is making 15%, investment B is making 23%, investment C at 20%, and investment D, which is on T-bills, is making 24% return. The weighted average return, if you put all these together, is 19.5%. Right? So this 19.5% return, right, on this 1 billion, say for 1 billion of pool of investments, will make roughly about 195 million rupees of total return. Right? So based on the individual investors' proportion of the investment, say for example, if someone had only invested 10 million rupees out of the 1 billion pool, he will be liable for 1% of the return made by the particular portfolio. Right? So this portfolio return will be apportioned among the individual investors based on the amount that they have invested in the particular fund. Right? So that's the concept of a unit trust fund. Right? And the benefit of a unit trust fund is that you can even start small, and it's invested in a pool of assets like what I've showed here. We've shown four types of assets that we've invested the portfolio in, and also it's in most of the cases it's a money market instrument, which means that you can use it almost like a savings deposit, right? So if you invest today, you can even withdraw the money tomorrow, right? So it's an alternative to a savings deposit, right? And the good thing is that there are professional managers who are managing the money for you. They will figure out what is the effective instrument to invest in. They know when to time the interest rates, when to go long, when to lock in the rates, right? So that helps you to effectively manage money better than you individually making the call of investing, whether to park it in a short-term instrument or whether you want to go long. That decision will be made by the fund manager itself, right? And also it's regulated by the SEC. Securities Exchange Commission of Sri Lanka, and also all the funds which come into the fund doesn't come into the unit trust management company. For example, in the case of CAL Investments, for example, if you're investing in a unit trust fund, you will channel the money through a custodian account or trustee who is Deutsche Bank. Okay? So Deutsche Bank will handle the entire money. So the money that you're investing doesn't come into CAL Investment per se. It is waiting in a different entity altogether, which is monitored by SEC and also by a custodian who's handling all the transaction for us, right? Which is giving an additional safety cushion. So this is just to give an idea of what a unit trust before we look at how we can use a unit trust to effectively manage our investments, right? So as I mentioned before, there is a very high possibility, right, that your income tax rates can be reduced in 2-3 years' time. Right? And also keep in mind that when different political regimes come into play, there is a different view on taxes. Right? So if they feel that the tax rates are high, that can also be a reason why they will kind of reduce the rates. Right? So if we feel, and based on what we think, if the tax rates come down to 24% in 3-4 years' time, what can we do? How can we capitalize on that? So I'm showing you 2 examples here. Right? The one on the top is a traditional bank deposit. Right? If you invest 20 million rupees in a bank deposit, and let's say, for example, the interest rate is at 25%, how are we going to kind of pay the taxes? Right? Let's assume that the total tax liability is at your personal tax rate of 36%. So if you're having a 20 million rupee deposit at 25% interest rate, you're making a 5 million rupee interest a year, which means that effectively you have to pay 36% tax rate on that return. Right? So on the 5 million interest, you will be paying 1.8 million tax. It's 5 million into 36%. That is your tax liability. So we are comparing this return against a fixed income unit trust. Right? As I mentioned to you before, the concept is that you have to only pay taxes if you realize the returns. Right? For example, in case of a bank deposit, if you take the interest at the end of the year or even during the month, you have to declare that particular component as interest and pay tax on it. But let's say, for example, if it's a 5-year deposit where the interest is only coming at the maturity, right? You only have to pay the taxes at the point of maturity. Right? You will pay the taxes for the 5 years, but only at maturity. Right? So you're postponing the payment of taxes. Right? And what will happen is the tax rate that will be applicable will be the tax that applies at that particular time. Right? Say, for example, if the tax regime changes in 2-3 years' time and it falls back to the 24-25% kind of levels in year 2, year 3, it doesn't matter what kind of tax rates apply during this particular period, what applies right now. What matters is what is the tax rate that will be applied in 3-4 years' time. Right? The tax on that day is what you will pay on your interest income. Right? So you're basically postponing your tax payment. So if you don't take your interest out every month or every year, right, you can push back the interest payment, not that tax payment, not that you are not going to pay taxes, but you're going to pay that tax on a future date. So there is a time value of money impact that will kind of come and hit you, right, which is beneficial, right? So in our first example, we've looked at a 20 million rupee deposit, right? Assume a 25% interest rate, which means that you will make 20 million into 25%, 5 million rupee interest per annum. And out of that, if you are taking interest out the 5 million in cash every year, you will pay 1.8 million in taxes. That is 5 million into 36%. So at the end of year 1, that 20 million will become 23.2 million. Why? Because 20 million, the 5 million interest gets added to it, and the 1.8 million gets deducted as taxes. So you will end up with a capital of 23.2 million, right? And this exercise goes on and on, right? So you're paying the 36% tax rate for 5 years in this particular case. I've taken a 5-year example here, right? And at the end of the period, the capital that you get back after paying all the taxes on a yearly basis will be 42 million. The capital that you get back will be 42 million, right? So let's say we use a unit the fixed income unit trust route, right? Now, for example, you will have a certain component of your money, which is normally investment, which you don't use for day-to-day use. Right? You're okay to put it away for future use, right? Future investments and so on. So if you have a component of investment which you're not going to touch, right? And if you don't need that particular interest income on a monthly annual basis, postpone it. Don't take it now, right? And fixed income unit trust fund helps you do it, because what happens is the interest gets accrued on the fund on a daily basis. Right? So unless you go and withdraw and take the interest out, the interest just gets accrued in the unit trust fund. Right? So if you had invested ₹1,000,000, say in 20 million in this particular case, and let's assume the same 25% interest rate applies. On the first 5 million interest, because we are not withdrawing the money out, you don't have to pay taxes on that particular year, right? So you're not taking interest as cash on that particular year. So zero tax is paid in year one, right? So what is happening is 20 million is earning a 5 million interest at 25%, no taxes paid. So your capital asset year one becomes 25 million, right? And same thing, it continues where you're not paying taxes because you're not taking the interest out as cash. Right? But what we are doing is in year five, right? Say political regimes change and the tax rate comes down. If the tax rate comes down to 24% in that particular year, what we are going to do is on all the interest that was accrued over the last 4 or 5 years, we are going to only pay 24% in year five, right? So first few years, we are not paying taxes at all. In year five, we are paying the lower tax. Right? So effectively, you're only paying 24% tax, and also you postponed your tax payments, which has saved you a bit of money, which is basically earning you interest, right? So by doing that, your effective tax rate reduces substantially, right? So same case, if you had invested 20 million rupees in a bank, at the end of 5 years, your return would have been 42 million, or your capital would have been 42 million. If you had parked the same in a unit trust fund for 20 million, right, and not paid taxes because you're not taking withdrawing the cash, right? And at the end of year five, when taxes reduce to 24%, right, if you take the money out, your capital will be 51.2 million versus 42 million that you will get on a bank deposit, right? So the trick that we are doing here is we are postponing the realization of interest. So if you have excess investment where you don't need that interest income to run on day-to-day basis, don't realize that into your income, postpone it. And the best channel to use for postponing your interest returns are the fixed income unit trusts, because the interest accrues and that interest is also earning interest, right? So you can keep postponing your returns using a unit trust fund, right? So this is a scenario if taxes are coming down in 2-3 years time, right? But let's say, for example, even if the tax rates are expected to stay at the same 36% rates at the current level, right? In year five, no change in taxes, it's the same. What is happening is the bank where you're putting 20 million will obviously be 42 million in year five, right? But even if you assume that the 36% tax is going to stay, right? The 20 million return, the investment that you're making, the fixed income unit trust, will only have to pay tax of 36% in year five, right? So basically what is happening is you're not paying interest on that particular year. You're postponing that interest. That tax component is being reinvested in the fund, right? And that's also earning an interest, right? By doing that in year five, right, your capital will be 46.2 million, still way greater than what you would earn on a bank deposit, right? So what we are doing is we are postponing the taxes, because the taxes are only applicable when you realize the income from your investments, right? So even if you do it on a bank deposit, you go for a longer term FD, for example, like a 5-year FD or so, because if the interest is coming at maturity, you only have to pay interest at that particular tax at that particular time. But obviously, banks won't offer you a great return if it's a longer term product, because their normal products are 3, 6, 12, where they give the highest return to, right? And banks would obviously not want to lock in at these particular rates. So the unit trusts are one effective way how you can effectively reduce your tax liability if you keep postponing Just give me a second. So the other asset class which can be used as an effective instrument to manage taxes are treasury bonds, right? So in terms of treasury bonds, you obviously have something called the yield to maturity, or the yield, or the return that you get on the bond, and what you call a coupon, right? Coupon is the cash that you actually get to your example. If a bond has a face value of 10, only have to pay taxes or personal billions, right? So where you right? So at that particular point, treasury bond, initially you only hello, can you hear me now? I hope the connection is clear. Hello. Okay. So I was explaining on taxes in terms of treasury bonds. So in terms of treasury bonds, as I mentioned, you only have to pay taxes on the coupon rate, right? And not on the yield to maturity, right? So in the initial years, you're only getting the coupons as cash to your hand. And as I mentioned, only during the realization of the coupon, you have to pay taxes, or realization of your interest, you have to pay taxes. Right? And the discount you only get at the end of the period, end of the maturity, right? So you're postponing the tax that you need to pay to the maturity period, right? So effectively, the tax that you're paying is less than what you would pay on a typical bank deposit or so. So since taxes are only supposed to be paid at the point of realization of interest, the personal income tax will only have to be paid on the coupon in the initial years, right? and the tax on the discount, which is the difference between the face value and the investment amount, only needs to be paid at maturity, right? So that's a postponed amount that we are doing, right? So if you look at the example here, we are looking at if you look at the numbers below, the face value of the bond is 20 million rupees. Investment is 14.1, which is the money that you're putting right now. And yield to maturity is 20%, and the coupon is 10%, right? So basically the price, you're only paying 14 million to buy a 20 million rupee bond, right? So the return, so you pay, so every year you will get 2 million to your hand, because on the 20 million rupee face value, right, you get a coupon of 2 million rupees. Right? On that, you will pay 36%. If you're falling into that 36% tax bracket, you will pay that particular tax on that 2 million every year, right? But in the last year, right, you have to pay for the discount component, right, which is the difference between the 20 million and the 14.1 million, which is a 5.9 million discount. Okay? So you only pay the tax on the discount at the maturity period. Right? So basically, the tax on the discount is postponed for a period of time, right? And that will effectively save you a bit of money in terms of the taxes that you have to pay. And especially if you are expecting taxes are going to come down in 3-4 years' time, right? It is better to buy a bond which is trading at a deep discount, right? When you say deep discount, when the bond has a lower coupon compared to the current yield of the market. So even if you look at the current market context right now, the yield of the market is about 25-27%, but coupon rate is only about 18%. Right? So you only have to pay taxes on the 18% right now, and not on the entire 27-28%. Okay? So this is another way that you can effectively manage your taxes. Right? The other good thing is that if interest rates come down, you obviously know that bonds will make a capital gain. Right? So on the capital gain component, as we mentioned before, capital gains are only subject to a 10% capital gains tax. Okay? So if interest rates come down and you make a gain on the bond, right, you will only have to pay 10% capital gain tax without paying a 36% tax rate. Right? So on bond gains, now if you look at the last couple of weeks, bond rates have been coming down. So for example, the 3-month treasury bill, for example, which was at 33%, is now almost at about 28-29%, right, in the primary markets, right? So with rates coming down, if you had bought a bill or a bond before, your price of the bond has gone up and you have made a capital gain. So if you decide to sell the bond or bill now, on that capital gain, you only have to pay a 10% capital gains tax, right? You don't have to pay a 36% rate, your personal income tax rate, because this is a capital gain component, right? So bonds have two benefits. One is that you're postponing your tax on the coupon, or tax on the discount, and only paying on the coupon. Second is that if interest rates come down and there is a capital gain, right, you only have to pay the capital gain tax of 10% rather than the personal income tax rate of 36%, right? And finally, the other investment asset class, which at the moment is completely exempt from personal income tax as well as WHT and capital gain tax, is equities or listed shares or investing in the stock market, right? So you can sometimes replicate the returns that you're making on a fixed income product by investing in equities in a share which is giving a higher dividend as well. For example, companies like Ceylon Tobacco, Chevron Lubricants are very high dividend yielding companies. For example, they pay roughly about 90-95% of their profits as dividend. Right? So, and if you look at the last 2 years, they have not been doing so because they've been unable to take the money out or the profits out as dividend because of currency issues. Now, with currency improving or FX flows improving, they should be able to declare dividends and take them out. Okay? So you will see these companies reverting back to their higher dividend rates. Right? And if you look at the current share price, a lot of these companies like Ceylon Tobacco, Chevron, can give you between 20-21% return gross of any taxes. Okay? So it's almost like a fixed income product, right? You're going to get that dividend. You're going to get somewhere between 15-20% kind of return, right? Just like a fixed income instrument, but in the form of dividends, right? The good thing is that when it comes to dividends, you only have to pay a 15% tax liability, right? So dividends will only be taxed at 15% compared to you be paying 36% as personal income tax in your file. Right? So if we take an example, say Chevron, say Ceylon Tobacco as an example, roughly we are looking at about 120 rupees a share as dividend for next year, which converts into a yield, right, of 21%. So if you invest 600 rupees as a share, you get 120 rupees as a dividend, right? And on that, you will only effectively pay 15% tax, right? Which will mean that your after-tax return is going to be 18%, right? If you look at a similar scenario, if we go with a bank deposit, the current rates that you're looking at on published rates on the websites are somewhere around 17, 18%. Right? But on the 17, 18%, if you're falling into the high income tax bracket, you will be paying 36%. Right? Effectively, which means that you will only end up with 11% return on your bank deposit. So even if you're investing in 17%, if you're crossing that 308,000 rupee total income for a month, you're going to be paying 36% even on your fixed deposit, right? Which effectively means that even if you are investing in 17% return, the net return that you're getting to your hand is 11%. If you are properly filing your taxes and so on, you will only get 11% to your hand. So what we are saying is using equities, companies which have a higher dividend yield, as an alternative to a bank fixed deposit. Since there are few companies which are giving a higher dividend yield, you can use that as a channel to effectively reduce your tax liabilities, because dividends are only going to be taxed at 15% compared to bank deposits, which can be taxed at a higher rate of 36% if you are falling into a monthly income, total income of 308,000 rupees or more. Right? So now going forward, whether it doesn't matter whether it's employment income or interest income, everything will be put together and taken as total income. So if your total income, inclusive of all kinds of income that you make, crosses 308,000 rupees a month, you will be falling into that 36% tax bracket, right? And it's a progressive rate, so you start from 6% going up to 36% in terms of your return. Right? So we are suggesting using the share market, investing in high dividend yielding stocks as an alternative to a fixed deposit, which is giving similar kind of return, or you're getting a better return compared to a bank deposit in this particular case. Right? And also equities has an added benefit, because this is only we're talking about dividend returns here. Capital gains, if the share price goes up, that gain is entirely tax free, because your capital gains tax on equities are completely tax free. So in terms of capital gain taxes, equities are completely exempt. It doesn't fall into your 10% tax bracket as such. Right? So equities is a perfect tax exempt product for you right now, because you don't have to pay. If you're falling into the higher bracket, I would highly recommend you have a portion of equities, right? And look at companies which are stable and can pay a higher dividend, because you can avoid paying that higher 36%, but pay a smaller 14% as dividend taxes, and on the capital return or the capital gain, you don't have to pay any tax at all. Okay? So these three products, unit trust, bonds, and thirdly the equities as an option, are the best tax efficient products available in the market right now. Right? Every other product, bank deposits and so on, if you're taking interest every year to your hand, you're going to be taxed at those respective tax brackets, right? Which is hello. Sure. Right. So in terms of tax efficient products, unit trust, by postponing the return that you're going to get on it without taking it as cash. Obviously, you can only do it if you have money that you can just put away and keep it. This is your excess money, your investment money that you're talking about. Second is bonds, because you're paying the tax on the discount component at the maturity, and also bond gains you only have to pay a 10% capital gains and not the 36% tax rate. And also on the equity component, capital gains is entirely tax free, and on the dividends you only have to pay 15% tax rate. So these are the tax efficient products. And just to give an idea in terms of what we're looking at in terms of the macro position right now, is from our perspective, we feel that interest rates are now sloping downwards or on a downward trajectory. We are seeing rates starting to come up over the last, if you look at last week's treasury bill auction for 6 months, it roughly fell about 2.6% from about 31 to about 29% in terms of rates. So we are seeing interest rates come down, and the reason being that with anticipation of IMF coming into the picture, we are expecting money flows or foreign flows coming into the market, right? So if the IMF agreement comes into play, and which is most likely going to be the case, because it looks like China and India are kind of giving financial assurances, and which means that Sri Lanka will be able to kind of get board level agreement for the $2.9 billion that we're supposed to get. Right? So if we get that, the money that comes in reduces our fiscal problem, right? And also you will see other channels activated in terms of other multilateral institutions being able to give us money, and overall the sentiment improving, which will start reducing the rates. Okay? So interest rates are on a downward trajectory, right? And I've shown two charts here. These are charts in terms of how markets have reacted to potential IMF agreements. And if you look at the good thing is that when sentiment changes with a board level agreement coming into play, you generally see markets starting to run, right? Because the anticipation is that after board level agreement, right, markets expect foreign funds coming in from even the equity funds, foreign funds will start coming back to the market, right? So that kind of drives momentum in the equity market as well. So we're expecting interest rates to come down and also see, and that's going to drive your equity market as well. And it's driven by two things. One is the probability of an IMF's board level agreement coming in by March 2023. And also central bank has been infusing liquidity to the market. So there's been a shortage of liquidity, but now the central bank has been pumping in liquidity to the market, right? Which has also helped bring down the rates. Third thing is that inflation is coming down. So if you look at numbers month on month, inflation went to a high of 70%. Now it has fallen to about 55%, and you will see the trend reducing gradually, right? With the central bank printing less money compared to what they were doing before, and commodity prices easing off. You're seeing inflation coming down. So there's a very high probability by the second quarter of 2023, the Central Bank of Sri Lanka can afford to cut policy rates. And if IMF also comes into play at that time, you can start seeing interest rates coming down. So if interest rates were to come down, in terms of investment strategy, what you need to do is A, start locking in your rates, locking in for a longer period of time without rolling your money for 3-month periods. B, if you invest in bonds, you might be able to make capital gains when rates come down. And C, in terms of equities, right, markets start to perform better if there is on low interest rates and anticipation of an IMF package. Right? And also in terms of unit trust, we are able to kind of optimize returns because we know when to lock in, and that professional expertise helps us to kind of maximize returns. Right? So these are the asset classes. So just to give an idea in terms of what kind of rates are running now, our secondary market rates on T-bills for 3 months, we're offering at about 26%. For T-bonds, this can be in range of 23.5 to 26.5%. And our unit trust product, which is the more tax efficient product that I was talking about, the postponed returns, gives you about 28% return on one particular product. And on what you call as an investment grade product, which is A-rated, is running at 26.88% at the moment, which is way higher than what the banks are offering at the moment. Right? If you have any questions, I'd be happy to take it. I see a few questions. Unfortunately, on the Islamic front, we are trying to launch a few funds, but at the moment we don't have any funds. There's a question on whether CAL has any Islamic funds. Unfortunately, at the moment we don't have any taxes. Second question is, do I need to pay tax for interest if the deposit is automatically reinvested? If it's reinvested, you don't have a problem. Only if you take it as no, sorry. If at the end of the period, if you're taking the money out and going back, putting it back, yes, you have to kind of pay taxes on it. Reinvestment, just taking the interest out and reinvesting it back, doesn't mean that you can avoid the tax liability. It is still a withdrawal and money going back. So you have to pay taxes on your deposit if you are taking the money and reinvest. Right? The only way that we can avoid paying taxes on interest at the initial period on deposit is if you enter into a longer term deposit, right? Say for 5 years, and take and ask them to pay the interest at maturity. Is the interest on a fixed income unit trust guaranteed? No, it is not guaranteed. We are talking about current, but obviously what we do is when we feel rates are coming down, we start locking in the investment returns, right? We start locking in the investment returns, which kind of helps us to maintain an above average return compared to what the banks kind of offer. What is the category of gain received from unit trust, capital or interest? In case of a unit trust, most likely scenario is that the gains will be treated as realized income, similar to an FD. So you will be paying the normal personal income taxes. Only if it's an equity fund, if you're talking equity related fund, that gain might be categorized as capital gain, and you might not have to pay the personal income tax, but the fund will pay the capital gains tax. Explain the computation of capital gains for a treasury bond. I might have to do it on another session in terms of when we talk about a treasury bond. It is basically, for example, if you buy a bond for say 100 rupees, and say because interest rates come down, the bond price goes from 100 to 120. On that 20 rupee gain, if I decide to sell the bond now, on that 20 rupee gain that I make immediately, I need to pay 10% tax. Right? So the price moves based on interest rate movement. Right? But this doesn't apply if you're holding the bond until maturity. Right? If you're holding the bond until maturity, you don't have a capital gain. You're not realizing the capital gain. Right? So if there is a sudden interest rate reduction and you make a capital gain, and like what I said, if the price of the bond goes from 100 to 120, on that 20 rupees, you have to pay a 10% capital gain and not a tax and not a personal income tax as such. Is there a chance of the rate of the fixed income unit trust going down? I highly unlikely. The only way that a fixed income unit trust can go down is if one of the investments default, right? For example, if you have invested in a pool of investments and if one of them have failed or one of them goes bankrupt, then your return can come down. If not, it is always an upward moving product, interest rate product, right? If you look at our history from 2011, we have 0 instances where there was a default on any particular investment that we have made. Right? And that is where our expertise comes into play in terms of figuring out which products have better credit quality, moving those products in time and fixing those rates at the right time. What about treasury bills? Is there a WHT? No, there is no WHT on treasury bill returns, right? So according to the regulations, treasury bill rates, they won't deduct you 5% and give you the money, right? You have to, but you are liable to pay personal income taxes at whatever the rate that you fall under. You will have to pay that particular rate, but WHT won't be automatically deducted at source for treasury bills as such. So there's also a question of what do you think of local debt restructuring possibility on things like bonds? And if it does, what will happen to our bond investments, right? So this whole talk about domestic debt restructuring has been going on, right, for the last 6 to 12 months. The problem is that even if the government wants to do a debt restructure, a very deep debt restructure, The problem is that our financial institutions cannot bear that kind of weight. So if you do, for example, if they cut down coupons by 50%, let's say, more than 50% of our banks will fall below their minimum capital, right? So unless the government finds ways and means of recapitalizing these banks, it is going to be a very difficult possibility to kind of cut coupons and so on. The best likely scenario at the moment is to push back maturities. So for example, if you have a 3-year bond, it might become a 5-year, 6-year bond, right? So they can push back the maturities. So that's one way they can reduce their interest burden, right? But giving you an example, now Ghana was trying to do a very a strong debt restructure, a very heavy debt restructure. And what has happened is that they are unable to execute it perfectly because the impact of the financial system is massive, right? So they're trying to now reduce the liability as much as possible and reduce that burden. Right? And the good thing is that since our bilateral lenders like China and India are almost only likely to agree for maturity extension, I don't think we have to take on coupon haircuts as such. So the probability has reduced substantially, and which has been the whole worry about domestic debt restructure has been why the rates have been remaining so high. So there is a possibility that if it's going to be a maturity extension or no debt domestic debt restructure, you're going to see interest rates starting to come down. And it may look like the case because if the bilateral lenders are not taking a massive, are not taking a principal cut and so on, we don't have to really push, or Sri Lankan government might not have to push for massive debt restructuring from the domestic clients as such. Will the unit trust also be NIC linked? Eventually, yes, it will be. But at the moment, unit trust is not tracked by the Inland Revenue, but effectively, their plan is to bring all the investment asset classes. But it's a timing difference. Why stock market is not performing yet despite tax advantage? It is the economic outlook which has been affecting the market, right? So if IMF comes into play and you see foreign investments coming back in, and also if you see interest rates coming down in this direction, you might start seeing the stock market performing, right? So it's just the economic outlook which has been keeping the stock market lackluster, but it will turn when you see the sentiment changing with an IMF program coming, right? So there's a lot of questions on this domestic debt restructure. The view that we share right now is that domestic debt restructuring seems a remote possibility given the impact of the financial institutions. If that happens in a big way, say for example, like the question that you're asking about in terms of if there's a coupon cut, even banks will find it difficult to kind of manage their deposits and so on. So that's the kind of scenario we are in right now as a country. So they can't afford to do massive coupon haircuts, right? The worst comes to a scenario is doing a maturity extension. I think that's the best possible scenario or the worst possible scenario that you have to plan, where the maturity of the bond might be extended for a period of time. So in terms of how the AIT applies to joint bank accounts, if there's two parties involved, you can break down the tax liability and pay. Right? So 50% liability can be, say, for example, if you have 100,000 rupees of interest income, 50,000 rupees of interest income can be shown in one file, and the remaining 50,000 rupees can be shown in another file. So that's an effective way that you can reduce your tax liability. If you have someone who is falling into a lower tax bracket, you can make them as joint account holders and pass on part of the tax liability to that particular investor or partner. Will unit trust return be 30% in the long run? No, it won't be. At the moment, it is running at 30%. But when rates come down, yes, the unit trust rates will start falling, but not at the rate at which your bank deposits and whatever will start adjusting. Which is why if you're looking at a scenario where you're looking at rates coming down, I would suggest you look at bonds and so on to lock in your rates. Any questions? There are a few more questions. I'll answer some of them quickly. So there's a question on equities. So when we consider equity exclusions under capital gains, any profit from selling share stocks is excluded, or is it counted if the earnings is more than 50K per month? It is not considered under the 50K per month. The return or the capital gain is entirely exempt. There's a question in terms of whether Deutsche Bank will act as a guarantor in terms of a unit trust. They are only a custodian. They will ensure that the process and the documentation is straightforward, but they don't give a guarantee, because if it's giving a guarantee, it's like investing in a better than a treasury bill at the moment, right? So there's no guarantee as such, but as what I said, over the last, we've been in operation from 2011, and we haven't had a single default in a unit trust. And the quality of investments, a lot of it, for example, our investment grade fund only invests in A grade, is rated by Fitch as A plus, and only investing in high quality investment products. So our credit research at CAL reviews each company, goes to each company, figures out what is the best possible scenario. So that's the difference in terms of why you need to come to a fund manager and not doing by yourself. Right? You may see attractive returns in the market right now, but you need to be sure who can pay you back. Right? We have a set of analysts sitting down here and working, crunching numbers, and going to these institutions, checking their credit quality. That's how we kind of come up with these investments, right? Figure out what is really credit worthy. Right? So gains on stocks, only dividends will be taxed, and obviously you're paying your transaction levy, which you're already doing at the moment. But apart from that, there is no other tax as such. So dividends in general are at about 15%. So that's so there's another question, and I think the question of domestic debt restructuring is coming up. I think to be fair, we will have a session on domestic debt restructuring and its impact probably in the next 2 weeks, because a lot of questions are coming on that, and we owe it to our clients to explain where we stand and kind of what the worst case scenarios will be, and what is the most likely scenario. So we'll cover that in a session, because there's a lot of questions coming on that. But I will address 1 or 2 questions. So one of the IMF requirements for giving the bailout package was domestic debt restructuring as well. That was not a mandatory requirement in the case of Sri Lanka. It was in the case of particular countries like Ghana, it was a case. Even though they said they mentioned about comprehensive debt restructuring and so on, it doesn't mean that domestic debt you have to touch the treasury bills and treasury bonds. Even state-owned enterprise debt is considered as domestic debt, right? And also SLDBs are considered domestic, right? So there are ways and means that which the government can avoid the domestic debt structure, and we will talk about a lot of the ways that we can the government can mitigate going through a domestic debt restructure. Why don't you introduce credit-linked notes by stripping coupons? These are things that we are evaluating at the moment. So there's another question in terms of the returns that we are posting on the unit trust, whether it's subject to WHT. So the returns that we are posting right now, the 26%, 28% that we are showing, is after the WHT. So when it comes to your hand, you don't have to pay a WHT as such. Okay? So the returns that we are presenting now as 26 and 28 is the fund is bearing the cost. The fund is taking the cost, and these are the net returns after WHT. So you don't get deducted an additional 5% like what you will be done with the bank deposit as such. Right? So the last month returns are after the returns that we are showing right now are subject to WHT. So they are after the WHT returns that we're showing right now. If you are an investor right now, you would have seen a slight impact on the returns. I think we were at about 38% return, which has come down slightly. And that is because of the impact of the WHT. Right? So you don't have to, there is no additional WHT you have to pay or you will be charged again in your investments. There's a question of, is EPF, ETF domestic debt part of domestic debt? Yes, it is part of domestic debt. But in most of the cases, pension funds are excluded, which is the complication that the government will face in terms of whom they can basically kind of penalize, because a lot of the financial institutions and the pension funds won't be able to kind of withstand. So unless the government puts in for a financial system stability fund, they won't be able to kind of meet the requirement. Given we are running short of time, let me stop the session at this particular point. But if you have any questions, feel free to kind of drop us an email or reach out to us on our hotline, and we'll be happy to answer your questions and help you in terms of structuring portfolios and returns, which will be tax efficient in nature. Thank you so much for joining in. And we will soon join you on a session on domestic debt. Thank you very much.